Employment in the UK has fallen again, while private sector wages grew at their slowest rate in 5 years. The number of people on payrolls in the UK fell 184,000 in December, leaving the unemployment rate steady at 5.1%. Growth in wages slipped to 4.5%. It's the latest data to show the job market is getting weaker, as unemployment has risen to 1.8 million and vacancies have fallen. Well, Hetal Mehta is chief economist at St James's Place. Hetal, what's going on in the UK's jobs market?
So it's obvious that we're seeing a slowdown here in the UK when it comes to employment, unemployment also trending up, and particularly wage growth now. The first time we've seen aggregate wage growth below 4% in, I think, more than 3 years. So it is a notable slowdown. I think some of the previous shocks that have hit the labour market may be kind of at play, but they may dissipate. So when we think about the national insurance contributions increase, which kicked in early last year, and then the national living wage picking up as well, those are all having a bearing on I think the ability of firms to keep hiring at a kind of pretty punchy pace as it had been previously.
There was a lot of uncertainty late last year around the budget. Is there hope of a recovery in hiring now that businesses at least have clarity?
I think some of that shock is dissipating, so I would expect the slowdown in the labour market to start moderating. But one of the key unknowns when we look forward, though, are things like the changes from AI and the automation. So whilst the backward-looking shocks are passing, there are increasing signs anecdotally and also in surveys that firms plan to increase the level of automation, and that might have some bearing on hiring from here as well.
Well, after this weak wage growth, we've got inflation data out tomorrow. What are you expecting there?
So overall, the last few inflation prints have actually come in lower than expected, and certainly lower than what the Bank of England had even been expecting. So I think that's likely to continue. I mean, some of the recent changes in oil prices may start to feed in. We don't look at just one data point, but when we look at that trend, you do have the feeding through of wage moderation, bringing core inflation lower, but headline inflation may still be affected by things such as oil prices.
Where does all this leave the Bank of England? How many cuts are you now expecting this year, and how soon?
So the Bank of England, as we know, has kind of had very split voting amongst the MPC members for a number of months, and we think that's likely to continue. The growth moderation through last year, the labour market moderation, is still going to keep the dovish members concerned that there's not enough monetary policy easing in the system. You could say interest rates are still arguably a little bit above neutral, but there are still concerns that despite the wage growth moderation, it's not enough to have inflation persistently at target. So I think that's still going to be a split. These kind of labour market numbers, though, should they continue, I think would move the dial and make it more likely the Bank of England cuts. So markets are pricing something between 1 and 2 cuts this year. I think that could pick up more through the course of this year should that labour market moderation continue.
And President Trump is threatening further tariffs on the UK and other European countries over Greenland. If last year's global trade war worries come back, how would that change the outlook?
So I think it's worth remembering that these tariffs would be quite difficult to implement. They're on a specific subset of countries. For Europe, it's specific countries. Obviously, Europe is a trading bloc, so it would be quite difficult to implement. For the UK, it's also worth remembering that we already have that kind of 10% tariff from the US on UK exports. So the 10% leg probably wouldn't make a meaningful difference to the UK. It's the threat of the 25% tariffs from June, which would be a significant escalation. But where people would expect your textbook explanation of tariffs would be that actually tariffs go up from the US, that would mean a stronger dollar and then weaker currencies elsewhere as other currencies try to gain competitive competitiveness by cutting rates, we've actually in some ways seen the opposite of that, where the question marks around the US economic framework are being questioned. We've seen a weaker dollar. So whether the tariffs this year, should they come into play, would actually generate the same sort of response, I think is still a big unknown.
That was Hetal Mehta of St James's Place. Don't forget you can watch more videos on Reuters.com.